Okay, let's dive into this. Picture this scenario. You're at the checkout, maybe online, maybe even in a store, ready to pay. And right there, next to the usual credit card options, you see a new button. Or maybe like several buttons, offering something really tempting, pay in 4, slice it, maybe just buy now, pay later.
Right. It's becoming ubiquitous.
It really is. And this isn't some fringe thing anymore. Our sources, especially the CFPB, the Consumer Financial Protection Bureau, they make it really clear. In 2022, something like over 1/5 of U.S. consumers with a credit record actually used one of these services.
That's a huge number. And it's up significantly from the year before.
Exactly. It shows real momentum. But it's not just how many people, it's how they're using it. That's what's fascinating. It's not just for, the big stuff like a couch or a TV anymore.
No, the examples are kind of wild.
Right. Get this. Over half the people at Coachella in 2025 apparently used payment plans for their tickets.
Wow. For festival tickets.
Yeah. And DoorDash is working with Klarna. You can split the cost of your takeout.
So everyday things now, too.
Totally. Groceries, wigs, those fancy coffee makers, even car parts. It's woven into daily life in a way that might surprise you.
Mm-hmm.
So that brings us to the core question, the real tension we need to explore in this deep dive. Is this super convenient, widely available payment method just, a flexible way to manage your money, get what you want when you want it?
Oh.
Or, like some of our sources are warning, is there a hidden debt trap under that smooth, often interest-free surface?
That really is the crux of it, isn't it? Because on the surface, it looks like just another option, maybe even a smart one, if you avoid interest. But when you really dig into the data, especially the CSPB's analysis, and you combine that with what financial experts are saying in places like Investopedia or Mint.
And even just what people share online about their experiences.
Exactly, those real-world anecdotes. You start to see a picture that's much more, complex.
Yeah.
Nuanced.
Absolutely. And that's why we're doing this today, taking this pile of research and really unpacking the whole buy now, pay later, or BNPL phenomenon in the US. We'll definitely talk about the big names you hear, Affirm, Klarna, but also understand the whole ecosystem, right? Afterpay, PayPal, Sezzle, Zip.
Yeah, there are quite a few players now. Our goal here is pretty straightforward, but I think essential. We want to pull back the curtain, understand how BNPL actually works, who's really using it, what makes it so appealing, those conveniences are undeniable, and then, crucially, dissected the potential risks, the downsides that the sources are flagging up.
So the listener, you can feel properly informed, empowered, really, before you click that BNPL button next time.
Precisely. It's about seeing the whole picture,
Well,
not just the shiny, convenient part.
couldn't agree more. Understanding the mechanics and the potential consequences is vital. So let's start at the beginning. What is buy now, pay later, fundamentally? How does it actually function?
Okay, so at its heart, you have to understand, BNPL is a type of short-term loan, financing. It might not always feel like a loan because of how it's marketed, but that's what it is.
Okay, the loan.
And the most common way it's structured, the one you see most often, is what's called the pay in 4 model.
Pay in 4. All right, break that down for us.
Sure. So typically, you make an initial payment right when you buy the item, usually about, say, 25% of the total cost. Then the rest, the other 75%, is split into 3 more installment payments.
And the big draw, the thing that gets everyone's attention first, is that it's often pitched as interest-free. Yeah.
That's exactly right. And it's a massive part of why it's taken off so quickly. For that standard pay in 4, the deal is usually no stated interest charged. If, and the big if, you make all your payments exactly on time according to the schedule.
Okay, so the math looks simple up front.
Yeah.
Just the cost, split 4 ways.
Yeah.
Right. And the purchase amounts it usually covers. Generally in the range of maybe $50 up to about $1,000. Although, like you mentioned with Coachella tickets or bigger things, it's definitely being used for pricier items too.
So short-term loan, often interest-free if you pay on time, typically for smaller to medium purchases. And the companies behind this.
Yeah, they mentioned some, Affirm, Klarna, Afterpay. PayPal's got its own version, Sezzle, Zip. These are the main ones the sources mentioned. It's usually not the store itself offering the loan, though big players like PayPal integrate it.
Yeah.
These financial technology companies, these fintechs, they partner with the retailers, online and physical stores to put that BNPL option right there at checkout. They handle the loan part, the store gets paid, and you, the shopper, owe the BNPL company.
Got it. So you're shopping online, you see something you want, maybe you don't want to drop the full amount right now. You click BNPL, make that first 25% payment.
Yeah.
Then what's the usual schedule for the rest?
For the typical pay in 4, those next 3 payments are often set for every 2 weeks. So you pay today, then again in 2 weeks, again in 4 weeks, and the last one hits around 6 weeks after you bought the item.
Okay, 6 weeks total, paid off quickly.
Yeah, the idea is it's fast, relatively simple on the surface.
All right, the mechanics seem pretty straightforward. Split the cost, pay it back fast, maybe avoid interest. Seems genuinely convenient. Which really brings us to the appeal. Why has this just exploded? What's driving people to click that BNPL button instead of, say, using a credit card or just saving up?
Well, the name says a lot, right? Buy now. The number one driver across all the sources is absolutely convenience. It offers that immediate gratification. You get the thing now without needing the full amount of cash now.
Right, that instant access.
And the fact you can use it almost anywhere now, like you said, for takeout, groceries.
Yeah.
It shows it's moved beyond just discretionary wants. It's creeping into necessities or frequent buys for some people.
Yeah, the integration is key.
Definitely. The examples like DoorDash and Klarna, or using it for groceries, coffee machines, car parts. It's not just random. It's so easy at checkout. It's presented right there, often looks like just another payment type, not like you're applying for a formal loan. Very low friction.
And that interest-free promise initially, that's a massive hook compared to credit cards, isn't it? Where interest can pile up fast if you carry a balance.
Oh, it's a powerful perception. Hugely powerful. If you're someone who maybe doesn't pay off your credit card in full each month, and you're used to seeing those interest charges, well, the idea of splitting a purchase into 4 payments with no interest sounds way cheaper, much more manageable.
It feels like you're dodging the interest bullet.
Exactly. It removes that perceived penalty, at least up front. Makes the purchase feel more affordable than maybe it would if you thought about potential credit card interest down the line.
Okay, so convenience, speed, it's everywhere, and that initial interest-free lure. Potent mix. Who's actually clicking these buttons most often? Let's dig into that user profile from the CFPB data and other research.
Yeah, the data is really revealing. As we said, over 21% of consumers with a credit record used BNPL in 2022. That's up from about 17.6% in 2021, so clear growth.
And within that group, some people are using it a lot.
Very much so. The sources talk about heavy users. That's about 20% of BNPL borrowers in 2022. These folks took out more than 1 BNPL loan per month on average.
Wow, more than once a month.
Yeah, so it wasn't just a one-off trial, it was multiple times regularly. And the average number of loans per borrower across everyone went up too, from 8.5 in 2021 to 9.5 in 2022.
So people are taking out more loans more often. It's becoming a habit for a significant group.
It seems like it's becoming a regular part of their financial behavior, yes.
What about their credit background? Is this mainly for people with great credit, or is it reaching a different group?
This is where the CFPB data really highlights some potential concerns, touching on that debt trap idea. The numbers show nearly 2/3, almost 66% of BNPL loans in 2022 went to borrowers with subprime or even deep subprime credit scores.
2/3. Wow, that's a striking statistic.
It really is. It tells you this isn't just a payment novelty for the financially secure. It's disproportionately used by people the traditional credit system views as higher risk. Now listen to this. For applicants in that subprime group, BNPL lenders approved 78% of their applications in 2022. That includes counteroffers, but still 78% approval.
So it's incredibly accessible, maybe especially accessible to people who might struggle to get traditional credit or who might already be financially fragile.
That seems to be exactly the case. It's opening a door where other financial doors might be closing. And younger borrowers are a huge part of this story, people aged 18 to 24. Almost twice as likely as the average person to use BNPL.
Twice as likely.
Yeah. And importantly, when they are using BNPL, when they have active loans, it makes up a much bigger slice of their total unsecured debt pie. We're talking about 28% on average for that age group in the months they're borrowing, compared to maybe 17% average across all ages.
That's a really important distinction. So while the individual loan amounts might seem small, for younger folks or those with less total debt overall, BNPL can be a very significant portion of their obligations. What are the typical amounts people are borrowing per transaction?
The average transaction was around $140 in 2022. Most fall between $50 and $150. Interestingly, the data suggests the first time someone uses BNPL, the purchase might be a bit bigger, average around $200. But after that first one, they seem to use it more for smaller, more frequent things, averaging around $50 a month after that initial use.
Which reinforces that idea of it becoming part of routine spending, not just big occasional purchases.
Exactly.
Okay, so we have this clear picture. Super convenient, feels interest-free, Very popular, especially with younger people, and those with lower credit scores, often used frequently for relatively small amounts. Now, let's face the other side, the potential downsides. What are the risks that could turn this convenience into that debt trap we mentioned?
Right. This is where the very structure that makes it appealing can flip and become a problem fast. That pay in full, while often interest-free, that's entirely conditional on you making every single payment perfectly on time.
The fine print matters.
Hugely. If you miss a payment, or sometimes even if you're just late, the terms can change dramatically. That loan that looked interest-free, suddenly you could be facing really high interest rates. Some sources mention up to 36.99% APR.
Whoa, that's high. Like high interest credit card or even payday loan territory.
Exactly. Plus, you'll almost certainly get hit with late fees on top of that, so the cost can balloon very quickly if you stumble.
Okay, so interest-free is definitely conditional. What about the impact on your credit score? This seems like a huge difference from using a regular credit card.
It's a fundamental difference, and a major concern raised in the sources. See, with a traditional credit card, if you use it responsibly, pay on time, keep balances low, you actively build a positive credit history, your score goes up over time, that helps you get better loan terms later.
Right. That's the benefit of responsible credit use.
With most BNPL loans, especially the standard pay-in-4 kind, making your payments on time generally does not help your credit score. The lenders typically haven't been reporting that positive payment history to the major credit bureaus like Experian, Equifax, TransUnion.
So no reward for good behavior.
Pretty much. You don't get the upside for your score from using it responsibly. But, and this is the crucial part, if you miss a payment, that default can be reported and likely will be reported, and that will hurt your score.
Okay, wait, so all the potential downside risk to your credit score, but none of the potential upside reward.
That's the common scenario, yes. It feels very one-sided in terms of credit impact.
And didn't the sources also mention some lenders might do a hard credit check up front, which can also ding your score a bit? And that some loans, like maybe from Affirm, depending on the type, could show up as a new account on your report, which also isn't always great for your score.
That's right. The specifics can vary between providers and loan types. Some might do a soft check, which doesn't impact your score, but others might do a hard inquiry. And yes, certain longer-term BNPL loans, maybe more like traditional installment loans offered by companies like Affirm, can be reported as a new trade line on your credit report. That increases your inquiries and new accounts, which can temporarily lower your score, especially if you open several quickly.
So it's complicated, but the general theme is limited upside, significant downside risk for your credit.
Generally, yes. And this lack of consistent, transparent reporting has bigger ripple effects, right? Like when you go to apply for something major, like a mortgage.
Yeah, talk about that hidden debt aspect. How does that play out?
It's a really important point, often overlooked. When you apply for a mortgage, the lender calculates your debt-to-income ratio, your DTI, very carefully. That's how much of your monthly income goes to paying off debts, student loans, car payments, credit card minimums, all that. Now, even if your BNPL loans aren't showing up on your main credit report from the big bureaus,
the underwriter might still find them.
Yes. Mortgage underwriters dig deeper. They'll likely look at your bank statements as part of the process. If they see these regular payments going out to Klarna, Afterpay, Affirm, they will count those payments against your DTI calculation.
So even if it wasn't on the credit report, it still counts against how much house you can afford, for example.
Precisely. It can feel like this hidden debt suddenly pops up at the worst possible time, potentially reducing your loan amount or even affecting your pre-approval. It's a blind spot if it's not being reported consistently everywhere.
Okay, so credit score risks, hidden debt impacting major loans. What about the basic behavioral aspect? The sources seemed really concerned that BNPL just makes it too easy to spend money you don't really have.
This is probably the most fundamental criticism leveled against BNPL. The whole structure, breaking the cost down into smaller bits, it kind of eliminates that psychological ouch of paying the full price up front.
Yeah, it numbs the pain of paying.
Exactly. It lowers the friction. And that can absolutely lead to more impulse buys or purchasing things that, if you looked at your total budget, you maybe couldn't truly afford. The small payment feels manageable, even if the total cost strains your finances.
It sort of bypasses the, can I really afford this? Check in your brain.
That's the concern. And unfortunately, the data suggests this isn't just a theory. Sources indicate that nearly half, almost 50% of people who use BNPL have run into problems.
Half. That's huge. Problems like what?
Things like overspending, missing payments, or just regretting the purchase later. That's a very high percentage experiencing negative outcomes. It's why you hear some commentators calling BNPL a dangerous game or, yes, a debt trap.
And that risk of overspending or regret seems like it would be amplified if people are juggling multiple loans at once. This loan stacking idea.
Yes, this is another critical area the CFPB data highlights. Loan stacking is very common. Around 63% of BNPL borrowers in 2022 had multiple BNPL loans active simultaneously at some point during the year.
63% juggling multiple loans.
And get this, a third of all borrowers, 33%, were borrowing from multiple different BNPL companies at the same time.
So you might owe Klarna and Affirm and Afterpay, all with payments due around the same time, plus your regular bills.
That's exactly the scenario. And remember, because these usually aren't reported to the big credit bureaus.
Right. A traditional lender looking at your credit report wouldn't see that full picture.
Exactly. You see your credit cards, your car loan, maybe student loans. But they probably have no idea. You also have 5 different $50 BNPL payments hitting your bank account in the next couple of weeks.
Which makes it hard for the consumer to even track their own total short-term debt, let alone for other lenders to assess their real risk.
Absolutely. It creates this huge blind spot. And the CFPB's findings strongly suggest BNPL use isn't happening in a vacuum. People using BNPL are statistically more likely to already have higher balances on pretty much all other kinds of unsecured debt compared to people who don't use BNPL.
Higher credit card debt, personal loans, student loans.
Yes, even retail store cards and loans from those, higher cost alternative financial service places.
That really suggests people might be turning to BNPL not just because it's easy, but maybe because they're already financially stretched thin.
The data certainly seems to point that way. For instance, credit card utilization rates. How much of your available credit you're using tend to go up just before someone starts using BNPL for the first time.
So maybe they're maxing out their cards or getting close, and then BNPL looks like another option.
That's a very plausible interpretation. It could signal that traditional credit is becoming less available to them. And as a group, BNPL users already have much higher average credit card utilization, like 60 to 66%, compared to non-users, who are around 34%. High utilization is generally seen as a sign of potential financial stress.
Okay, so this puts the small average loan amount idea into perspective. While the average BNPL loan might be, say, $140, and maybe overall BNPL is only 1% of total unsecured debt in the U.S.
Right. But that 1% average across the whole population is super misleading. It gets diluted by people with huge mortgages or student loans who don't use BNPL. For the people who are using it, especially those younger users we talked about who maybe don't have tons of other debt yet, BNPL can be a much, much bigger piece of their personal debt puzzle.
Like the 17% average share you mentioned, or even 28% for the 18-24 group when they're borrowing.
Exactly. For those individuals, missing a BNPL payment or having several stacked up could have a way bigger impact on their overall financial health and make their debt feel totally unmanageable.
That paints a much sharper and frankly more concerning picture, especially for the groups adopting it fastest. Now, there is one point in the sources that added a bit of nuance regarding risks specifically about default rates. It said BNPL default rates are actually lower than credit card default rates for the same group of people. How does that fit with the debt trap narrative?
Yeah, that's an interesting finding, and it requires careful interpretation. The average default rate on BNPL loans between 2019 and 2022 was about 2.1%. Now, if you look at the credit card default rate for those exact same people, the ones using BNPL over the same period, their credit card default rate was much higher, around 10%.
Okay, so the same person is less likely to miss a BNPL payment than a credit card payment. Why would that be?
A big reason, suggested by the sources, is likely the payment mechanism itself. Many BNPL services require you to set up automatic payments.
Auto pay from a debit card or bank account.
Right, or even linked to a credit card sometimes. That auto pay drastically reduces the chance someone just forgets to make the payment, which is a really common reason people default on traditional credit products where you often have to manually log in and pay.
So it might be less about financial discipline and more about the system forcing the payment, a guardrail against forgetfulness.
That's a very strong possibility. It removes one common way payments get missed. But it's really important to stress, even with that lower rate, defaults still happen. And they happen more often among certain groups, like younger users. And the core problems, the loan stacking, the lack of reporting across different providers, those still exist. So the full picture of someone's total debt and overall default risk across everything they owe is still murky.
Right.
A lower default rate on one specific BNPL loan doesn't mean the person isn't struggling. Making those BNPL payments via autopay might be squeezing their budget so tight that they end up defaulting on other things like their credit card or a personal loan, which are clearly reported.
That's a critical distinction. The autopay might mask deeper stress that shows up elsewhere. Okay, given all these risks, what alternatives do the sources suggest for someone tempted by BNPL, and is there any way to use it responsibly, according to the experts?
They definitely offer alternatives. A common one is considering a low APR credit card, especially if you can snag a 0% introductory offer for a while. The big advantage there, again, is that responsible use builds your positive credit history, unlike most BNPL.
Right, the credit building aspect.
Of course, the most basic alternatives are still valid. Use a debit card if you actually have the money now, or, the old-fashioned way.
Oh.
Budget for it, save up, and buy it when you can truly afford it without borrowing.
Spend within your means or use credit tools that help your financial future. What if someone still decides to use BNPL, knowing the risks? Any tips for minimizing the potential damage?
Absolutely. The sources give some clear advice for responsible use if you choose to go that route. The number one most crucial principle is this. Only use BNPL for something you could genuinely afford to buy outright with cash right now.
Don't use it to stretch beyond your means.
Exactly. Think of it maybe as a cash flow tool to split a cost you can already cover, not a way to buy things you actually can't afford. Beyond that, it's all about the details. Read the terms and conditions meticulously, every single time, before you agree. Look for fees, especially late fees. Understand the interest rate if you slip up.
Know what you're getting into.
Yes.
Yeah.
Be brutally honest with yourself about whether you can make all the payments on time, given your income and other bills. Setting up autopay can help avoid accidental misses, but don't let it make you complacent about tracking the payments. Always compare, is BNPL really better than using my credit card for this? Consider the impact on budget, potential interest, credit building, and try really hard to avoid using it for routine stuff like groceries. That can quickly become a confusing mess of overlapping small payments that are hard to manage.
Okay, so it's not like it's pure evil, but it demands extreme caution, self-awareness, discipline, and really understanding the fine print. It could be a tool, but only if used very carefully for things you already afford.
Precisely. The ease of use makes it easy to misuse. The responsibility falls heavily on you, the consumer, to be informed and disciplined.
Interesting side note before we wrap up, one source mentioned the CEO of Affirm apparently isn't a fan of the term buy now, pay later. Any thoughts on why, given everything we've discussed?
It's speculative, of course, but it likely comes down to marketing and perception. The phrase buy now, pay later explicitly includes pay, which highlights the debt, the loan, the obligation.
Right, it sounds like debt.
Which, given the growing criticism about debt traps and the need for regulation, might not be the image the industry wants. Companies might prefer framing it as something softer, more empowering, like a flexible payment option or a payment plan or maybe even a budgeting tool.
Focus on the convenience, not the borrowing.
Exactly. Shift the narrative away from potentially scary debt towards something that feels modern, consumer-friendly, light, even if the underlying mechanism is still very much a loan. It's about shaping how people feel about the product.
That makes perfect sense. Controlling the narrative. Well, this has been quite the deep dive. We've looked at the incredible growth of BNPL, its clear convenience, why it's so appealing, especially to younger people, and those maybe shut out of other credit. But we've also spent a lot of time unpacking the serious risks, the conditional interest-free part, the potential damage to your credit without the upside, how it can really encourage overspending and impulse buys, and this whole issue of loan stacking creating hidden debt burdens.
It really does feel like a technology with two distinct faces. One side offers flexibility, access, immediate gratification. The other side, though, that same ease of use, combined with often opaque reporting and the tendency for users to pilot multiple loans. It creates a real potential for financial distress. For some groups, maybe even a high probability.
Which leads us right back to where we started. Is buy now, pay later mostly a convenience, or is it fundamentally a debt trap?
Based on everything we've looked at, the fairest answer seems to be it's both. Which one it turns out to be for you seems to depend almost entirely on your own financial habits, how well you understand the specific terms you're agreeing to, and crucially, your ability to juggle those multiple payments without fail.
So for someone disciplined, using it strategically for something they could afford anyway, maybe it's just a convenience.
Possibly. But for someone already struggling financially, or maybe just prone to those impulse buys, it can become a trap very, very quickly.
The key takeaway, then, it feels like, is just fundamental financial literacy, right? You absolutely have to understand how any financial product works before you use it. Read the fine print, be honest about your ability to repay everything on time, and know how this new debt fits into your overall budget and existing obligations.
Yeah. Don't let the ease of clicking that button replace careful thought.
That diligence is your protection.
Absolutely.
So here's a final thought, something for you, our listener, to mull over as you navigate this changing payment world. Given how incredibly easy and just present BNPL is now popping up for shoes, for groceries, for concert tickets, for everything, how does this shift actually change your relationship with spending, with budgeting? Does splitting that payment make you think differently about whether you can truly afford something? How do you make sure you're grasping the total cost, not just the first small installment, whether it's a big purchase or a small one? It's a really fundamental question for your own financial well-being in today's world.
Definitely something worth reflecting on next time you're at that checkout screen.